A splendid evening it is to you viewers. Welcome to Equity News on Equity Access, your aerial perspective of stock market developments and of developments in the Zimbabwean economy. Thank you for joining us as we broadcast live from our Hampton studios in Harare. I'm Ibn Mabunda. Let's get on to business. Well, it's a reporting galore, and that reporting galore has reached its climax with several companies releasing financial results. Yesterday, 7 companies across the board released financial results. Today, a total of 10 companies released financial results in a bid to come to terms with the stipulations of the Zimbabwe Stock Exchange. Of course, financial results being extended in terms of reporting by period of a month right up to the 30th of April, which is today. So hence the galore that we have actually witnessed. But before we can get into the financials, we just have a perspective of what has taken place in terms of the general economy at large. Well, government surplus trend continues. Let's get into the statistics so that we get an appreciation of what it is that has actually been taking place in that regard. Well, of course, the Minister of Finance has said repeatedly that government is solvent and we're running surpluses, and we have been doing an average surpluses of 100 million since September last year when we came in January with surplus of 102 million, February 85.5 million, as we had to take into account cushioning of civil servants. In March, our surplus doubled to just about $200 million. Well, let's take a dive into the stats. From a historical perspective, this is January of 2018, where of course we had a surplus of $26 billion, moving right up to May, where we had a deficit of $361 million. August of 2018, a deficit of $651 million in that regard. Well, there was a significant improvement as of September 2018. Now that's November 2018, where we recorded a deficit of $242 million. Then, of course, austerity is introduced austerity measures are introduced right from October, 2% intermediate transaction tax. Then moving right up to December, where we recorded a surplus of $732 million. January, $102 million. Then of course for February, that's $85.5 million. Well, of course there is a mismatch there between what the minister said, but positive story there is that we have actually been sailing in the positive, and hopefully that trend actually continues and positives continue to be recorded across the economy. Then moving on to the stats, onto the financial results. Cigarette manufacturer British American Tobacco held an analyst briefing at the capital with 2018 financials being presented. Revenue increased 16% to $42.7 million for the year ended 31 December 2018. That, of course, from $36.8 million recorded in the year 2017. This was driven by strong sales performance and an improvement in the sales mix. Company's volumes increasing 16%. Of note is that the Ascot, which is one of the brands that they sell, scaled 171% in terms of volumes. Sales and marketing costs were at $5 million, an increase of 3% compared to the US $4.9 million recorded in the same period last year. Profit after tax growing 40% to $14 million. Let's just get into the stats as well as the historical perspective of how the corporation has actually performed, or wrong in engagement there, but right, bullseye. Now, this would be full year 2014, where they recorded revenue of 44.6, 2015 revenue 45.3. Well, there has been there was a decline from 2015 into 2016 to $34.1 million, 2017 36.8, 2018 there has been a jump there to 42.7, and also in line with that trajectory has been the profit after tax of 8.5 in 2016, 10.6 2017, right up to the full year of 2018, where there has been a record of $14.8 million. Well, the company, of course, lamented the increase by government in terms of excise duty. I had a close up with the finance director, Leslie. Let's have a look. Good morning.
Good morning to you.
Fantastic. Congratulations on a positive performance, growth in revenue as well as growth in profit after tax.
Thank you.
Splendid. Just in a nutshell, would you want to take us through what were the contributors of such a positive performance in that regard?
Okay, thank you. I think the major movers for our revenue growth of 16% was mainly the volume, which was 16%. So it was more of an organic growth on the volume for the business. If you look at pricing, we only took pricing at the back end of 2018, which was in December, driven by mainly the excise increase. That increased from $20 per mil to $25 per mil. If you look at profit after tax, I think it increased by about 40%. This was mainly driven by obviously efficiencies we're starting to realize in our manufacturing processes as our volume is also increasing. And also, if you look at just our cost base in terms of our marketing costs, they were fairly flattish with a 3% increase, which obviously on a year-to-year basis, when you're looking at increased gross turnover, it then flows through to your profit after tax. If you look at our overheads as well, they did go down by about 5%, which also obviously also contributed to an increased profit after tax. This has resulted in the 40% that we're seeing on the profit after tax.
I realize. Now let's talk about trends on your financials. Over the past 3 years, there's been a decline in terms of your PPE. At the same time, your cash in utilization in terms of investments has also been on a decline. Does that spell out the strategy of the corporation, or what is the sentiment with regards to the strategy going forward?
So if you look at our PPE, yes, there has been a decline in trends. This is mainly driven by probably the type of investments we've been doing. I think if you look maybe 3 years, we did a bit of factory upgrade here and there. But if you look at over the last 2 years, the main investments has mainly been on the route to market, which has been the vehicles probably for selling our cigarettes and a few of the office stuff. We haven't really been doing much upgrades in the factory. This is mainly driven by, if you look at what we currently have, it's still adequate enough to be able to produce the volumes for Zimbabwe. And obviously, if you're to look at any capex in the factory, it requires foreign currency and like was mentioned in the brief, any line you're looking at 8 to 9 million, which is quite a big investment. But currently, we have sufficient capacity in terms of actually meeting our local volumes.
Fantastic. Then on to the increase with regards to the excise duty. Would you want to shed more light where that is concerned in terms of what are your expectations in terms of the impact of your performance going forward?
So I think in terms of impacts in performance going forward, obviously we'll continue engaging with the government in terms of what sort of excise we see that is a win-win for both BAT and the government. Looking back at the $20 to $25 that was taken in December, we did also take a price increase. And if we look at our performance as of now, the impact obviously has been kind of marginal, mainly driven by, I think there are other factors as well that are. So as much as you take price increase based on excise, you will find there are other components that are coming into play when you look at the economy,
of course.
Which is, as we look currently, obviously the increase has had a marginal impact. So it's not really significant at the moment. But the question is how we take it going forward in terms of our engagement with government so that we continuously have a win-win excise regime that doesn't sort of impact on our businesses. So the government will get more revenue, but will also be able to sell. So we have to find that right balance.
In other business news, ZB Financial Holdings released 2018 financials. Revenue grew 21% to $83 million from $69 million recorded in 2017. A profit after tax of $22 million was recorded in the period in question. In December, the group accessed a $30 million credit facility from Afreximbank, which according to the group is earmarked for local exporters. Of course, this would be an initiative by the group to actually generate the much needed foreign currency. Well, the group is also seeking to launch ZB reinsurance in Mozambique and struggled to raise the $1 million required to actually get the process in motion as well as getting it to reach its fruition. Well, I had a close up with the Chief Executive, Ron Mutandagai. Let's have a look.
Thank you very much. I think the major drivers were the fact that our account numbers are increasing. We do have a number of competitive products in the market. If you look at the schools, we're probably the biggest bank in that area. If you look at churches, we've been offering very good products around that. Another area that has contributed to our good performance is mortgages. Our mortgages have gone up. We've faced a few headwinds around sellers of property demanding cash or US dollars. But for those that are able to accept mortgages, we've been able to fund those. Another area where we've seen an improvement in the business is on our corporate finance side. Our corporate finance side is becoming more and more visible. We've raised funding for a number of institutions, and we will continue to do so for the foreseeable future. The $30 million is directed towards exporters. As you know, if we lent the money to importers, we would obviously have difficulty with repayments and exchange risk. So we are offering exporters funding, and the funding is across all sectors of the economy, principally mining, agriculture, tourism, and us to generate more revenue. I think it's accepted that the country requires more exports, so we will be offering the funding to export-oriented industries. I think we've had some difficulty raising the funding that is required. The budget there is $1 million to allow us to get working capital as well as assets that are required for us to operate. We are in the process of trying to raise that amount of money. We're chatting to a number of international organizations who have expressed interest in supporting us in that initiative. Our previous application had already been approved by the Mozambican authorities, but because we did not follow it up with an investment, we now have to revalidate that application. So currently we are in the process of engaging the Mozambican authorities so that we revalidate that application. They've also indicated that instead of a cash investment of $1 million, they're quite happy with a guarantee. So if we're able to get somebody to guarantee the funding that is required, we will be able to move into Mozambique sooner rather than later.
ZB also spent $5 million on its IT infrastructure. 1,500 point-of-sale machines are currently in distribution, and a target of reaching 12,000 by year-end has actually been set. The group is considering further investments in the IT sector. Let's have a look.
In this environment, IT expenditure is absolutely critical. The group has adopted a digitalization strategy, which means that we need to modernize our networks, we need to modernize our equipment, we need to modernize our servers. The $5 million that we spent during the course of the year was principally directed to routers and servers and surround systems like that. But I think we would like to go on to a major digitalization project so that the bank moves from being a bricks and mortar to a digital bank. And those are the plans that we have. Our budget so far seems to suggest that we need to spend at least $10 to $20 million on the digitalization exercise. We will obviously face difficulties in terms of raising that kind of money in this current market environment. So we'll have to do it on a piecemeal basis. As you know, we're the first bank that went paperless as far as the front office is concerned a few years ago. We are revamping that paperless initiative. We are now going into the middle office to ensure that systems are optimized, investment in document flow, workflow management, to allow our staff members to be more efficient. So we think that digitalization is the route to go, and we will continue to invest in digital platforms going forward.
Meanwhile, ZSE listed microfinance bank Getbucks issued a cautionary statement. Well, according to the cautionary statement, the company is contemplating a capital raising transaction which, if successfully concluded, may have a material effect on the price of the company's shares, and accordingly shareholders and members of the public are advised to exercise caution. But what do we have playing here? Possibly, Getbucks could be taking initiatives toward launching as a fully fledged bank. This, of course, is according to interest that Getbucks has actually expressed in recent periods. Well, almost 5 years ago, the Reserve Bank of Zimbabwe increased the minimum capital requirements for commercial and merchant banks to $100 million from US 12.5 and $10 million respectively. With 13 operating commercial banks, only a couple have surpassed the minimum capital requirements ahead of the 2020 deadline. And Getbucks could be looking to raising capital toward that. Well, this concludes our news bulletin. Up next is news review, and to discuss that, I will be joined, of course, by our very own investment analyst. Please stay tuned. Welcome back, viewers. I'm now joined in set by our very own investment analyst, Tinashe Kaduo. Tinashe, good evening and welcome to the show.
Good evening, Ethan. How are you doing?
Won't complain. You don't get better yourself.
I'm very okay. Good evening, viewers.
Fantastic. Let's get the ball rolling. We'll start by having a look at Getbucks. They have, of course, issued a cautionary statement which could be interpreted perhaps a couple of ways. And as I reported that they are, of course, considering a capital raise which could change the complexion of the microfinancing bank. What is your perspective where that is concerned?
Thank you. If you look at Getbucks' performance, especially recently, it was one of the most successful deposit-taking microfinance institutions. As a deposit-taking microfinance institution, I honestly think that maybe Getbucks is actually preparing itself maybe into a full-fledged bank. So maybe this capital raising initiative is actually trying to transform itself into a bank with capital of around 17 million thereof, if I'm not mistaken. I think their shareholders, they're actually considering a decision where they want to raise their capital to levels around 100 million for them to be either a merchant bank or a commercial bank. But in terms of performance, actually we have seen over the past period, Getbucks has been actually aggressive in terms of enhancing its e-channels and actually enhancing its non-funded income line. So it was actually competing with banks in that space. So I believe it's a company which is looking into itself that in terms of its performance, it can actually even enter in the banking space. So the capital raising initiative, I really believe maybe is a company that wants to transform itself into a fully fledged bank.
I realize, but what would be the prospects of them actually making progress and winning in that space?
The sad thing in this economy is that over the past couple of years, we have seen so many companies that have tried to raise equity through the equity market, but they've actually failed to raise the desired equity. If you look at Getbucks, when it did its initial public offering, the uptake of its shares, it wasn't to its expectations. So I really believe this is a market where investments are in that space, they are depressed. So for them to really raise enough capital, I feel they might struggle here or then. But the good thing is actually good brand, and maybe they might be able to attract a foreign shareholder.
Okay, well, interesting perspective right there. All the best with their endeavors. Yeah. Now on to BAT. They have of course released their financials, and of course I was at the analyst briefing, and this is what we have actually seen play out. Revenue of $42.7 million, while there's also been profit after tax of 14.8. What is your comment in terms of the performance of cigarette manufacturer?
If you look at this cigarette manufacturer, it's actually reaping the benefits of being diversified. If you look at BAT, it actually took a strategic initiative to invest into a diversified cigarettes brand portfolio. It has got its premium brand, your Newberry and your Daniel, and it also has the lower end, your Madison and your Everest. So if you look in terms of this performance, what actually drove the top line was a 35% increase in terms of volumes and revenue for its Everest product. Then also Madison was performed actually well. It actually added 16% to its revenue line. Then also the Newberry, it did performed quite well together with the Daniel. But of essence there is, your Daniel was actually, a bit affected by the statutory instrument 253A, where the government is charging, duty, excise duty in Forex for your important brands of cigarettes. The Daniel is actually, manufactured in South Africa, so it's actually a concern, for the company. But it's a company that's actually, enjoying the benefits of being well diversified. But of importance there is, if you look at the performance of your revenue going up from 16 to 22, then your operating profit going up from, your revenue going up from your 36 to 42, then your operating profit going up from 16 to 22. You see, in terms of the magnitude, the growth is almost equal, implying that they actually managed to contain the costs. Your operating, your profit after taxes went up from 10 to 14, implying that this is a company which has actually managed to contain costs in light of this inflationary environment. But of essence, there is what we have seen in terms of the operation development of BAT. It's a company that used to declare 100% as dividends in terms of in terms of their net earnings. But since mid last year, they scaled down in terms of declaring dividends, maybe which might speak to this constrained operating environment where companies might declare dividends, but they are not able to repatriate that dividends to their foreign shareholders. So in that space, I think maybe BAT is actually taking a strategic initiative that they should maybe rather reinvest that those proceeds are in their operations in light of this constrained foreign currency environment.
I realize. Now, of course, we cannot talk about BAT, not talk about what's happening in the tobacco space. With decreased volumes as well as decreased values in terms of what has actually been brought to the auction floors, and of course on the contract farming side, what could be the impact of such a trend with regards to the performance of the corporation going forward?
If you look at in terms of the volumes, if they are actually depressed, it means that its input or key input sourcing costs they might go up. Then if you look at its structure, where one of its premium brands, your Daniel, is actually manufactured in South Africa, then the regulator is saying that you have to pay your excess duty in forex. So this is a company, in terms of its sales, its net earnings, it gets it in your local RTGS dollars, but it actually imports, or it has to pay from its manufacturer in South Africa in terms of forex. So when duty now is being charged in forex, it's actually a major concern for the company. Then in terms of the outturn of the tobacco selling season, we are actually projecting output which is below 200 million kilograms, which is actually way below the 252 that we produced last season. This is actually a concern, especially to this tobacco processing giant.
Okay, I realize. Now, of course, I know that you can't wait to get into the government budget surplus strength and vis-a-vis what, of course, the finance minister has said. What is your comment? What is your sentiment with regards to the surplus? Well, compliments there for actually having been able to record such surpluses in that particular regard. What is your perspective?
If you look at the progress in terms of these government numbers, you're seeing that from your January 2018 up to your December or your November thereabout, we're actually deep in the deficit side. But in terms of January 2018, we're seeing that in January it's more like a common aspect where the government actually records a bit of a surplus. Then in February, a small deficit. But this progress in terms of your government numbers, maybe to add on to what the finance minister, Professor Mtulingwe, was saying, he was actually upbeat in terms of the government numbers, saying that the fiscal position is now sound. The government is recording surpluses of averaging 100 million per month. But if you really dissect these numbers, the deficit, the surplus is actually coming from the over expected outturn in terms of the revenue side, rather than the curtailed expenditure side. In terms of the expenditure side, we are actually still spending more than what we have budgeted for, which is actually a source of concern. So the revenue outperformance is actually a result of your overburdens in terms of the tax position. Your 2% tax and your excise duty on alcohol, on tobacco, which actually affected BAT's dining performance. That's where that revenue is actually coming from. So when you overtax the economy, in the short term, yes, you may experience a surplus, but that's not sustainable in the longer period.
Hold on a second. this is the point where we have the introduction of the 2% tax. Now, prior to that, we see a series of deficits. I mean, look at August, where we recorded $650 million in terms of deficit. Now, this is the time when we see the introduction of the 2% tax. So the effects get registered in ensuing months. And there we see that there's actually been an improvement in that regard. Is that not a positive? Are you?
Let me to explain it better. If you look at these numbers, your performance actually in terms of your June, your July year, and your August. This is actually a period where we had elections, and the deficit was actually something to do with your elections financing, which is something that we will not incur going forward. So from your September, I'm happy that we almost balanced the budget, where you are seeing your deficit is actually closer to zero. But when you introduce the 2% tax, to me, what matters more is these, your expenditures bars, the purple bars, which are constantly up there, even here at these levels, compared to same period last time. Look at your February there, and compared to your February here, our February is actually up when compared to February last year. So implying that there is little being done more to curtail your expenditure side. So the expenditure side, to me, that's a source of worry in terms of fiscal consolidation strategy. So when you try to consolidate your fiscal position using the revenue side, to me, that's not the best strategy to use. For us, some of me, I consider myself as a supply side economist, where I believe that when you intervene using your demand interventions, you curtail demand, you kill your demand, and you actually kill the propensity or that innovation for companies to produce more. So the 2% tax, what is being done, what it is doing to both on the demand side and on the supply side is, with the 2%, individuals or the consumers in the market, they now have little, your disposable income, implying that your demand is now curtailed. Then you see the supply side now, when there is no enough demand, there is not much incentive for you to produce more. That's why you are seeing now companies, instead of producing more, they'll produce the same level of output, but they'll increase the price for them to protect the margins. That's what's happening to the economy. So I believe the finance minister, he actually knows that this intervention is not sustainable in the long run. So it's just years to be a short-term intervention. And I strongly believe that the honorable minister maybe should reverse all these policies after this year.
But according to him, he is quite impressed. He is very happy with this particular trend and has been on a global campaign letting the world know that things are now back in the positive. So
but maybe to add on as well, there are also some other unbudgeted for expenditures that maybe I hadn't mentioned for the benefit of our viewers. If you look at the subsidy to agriculture, the 38% subsidy to agriculture, where the government increased the producer price of your maize and other grains by 38%, it means that on your expenditure level, there is that 38% ballooning to expenditure level. So it means you will start to realize, to see the impact of that increment on the April and May figures. So the February figures, they don't have that 38% increase in your producer price of maize. Then in April, starting April, the 1st of April, government actually raised salaries for civil servants by massive 26%. So we will see that outturn for the April numbers going forward. So to me, the 8 billion budget in terms of expenditure side, I really believe by June we might have used it up, and the finance minister might need to raise maybe a supplementary budget to it.
And is that not being exaggerated to say by media would have exhausted?
No, but if you look at your expenditure side, if we are now consuming, look at your January and February alone, 520 million for February. So if you say February 520 million and you run those numbers up to June, that's 6 months, 500 million, that's about 4 billion. Then there are other, unknown expenditures that will come in, considering that. So by June, we might see the finance minister raising, a supplementary budget. Then in terms of how the revenue is being constituted in terms of, your major tax years. If you look at our 1995 to 98 position, this is a period where I consider the economy, was in at a better position.
Let me raise these before you can continue with that. Cleared for takeoff.
Thank you for that. If you look at it, it's our period, your 1985, your 1995 to 2000. If you look at it, your payee was your largest contributor to your tax revenue. This actually speaks, to the employment levels that were prevailing in that period in the economy. But now, due to industrialization and the death in the manufacturing sector base, we are now seeing your payee now just contributing about 15.7%, down from your 30.2%. And your Zambia, which is our near example here in Africa, is actually collecting your 20.4% from your payee. Then a company tax, 12.1%, now is 12.6%. Yes, it's actually stayed the same. Your VAT, that's where now the major contributor to your revenue. This is where we have added, some extra tax burdens to the manufacturers and also to retailers. But the problem now with when you charge much in terms of your VATs and your company tax, they actually kill your incentive to produce. No one would actually want to invest in an economy when you have got so much high taxes as well. Then you look at this indirect tax, what we are saying, other component, that's where your intermediated 2% tax comes in. It's actually grown up from your 6.7% in terms of contribution to 13.9%. And you compare it to Zambia, about 0.9%. That's why we are saying that the finance minister now should consider that maybe we should shift our economy from a position where we rely much on indirect taxes, but we have to focus more on the direct taxes. Because the indirect taxes, they actually kill your incentive to produce, and they also contribute to high cost of doing businesses in the economy.
Well, quite elaborate there, Tinashe. Thank you so much for the insight. Viewers, please stay with us. Up next is a look at how the stock market has performed. Please stay tuned. Welcome back, viewers. I'm now joined in set by Anesu Chumbumu, one of our very own investment analysts. Anesu, good evening and welcome to the show.
Thank you, Eben. How are you doing today?
Fantastic. Yourself?
Good, thanks. Good, thanks. Well, we are continuing on a rally, about 7 sessions up now to date, with the all-share index coming up 1.78%, while the industrials index did add 1.8% for it to settle 446.52 points. The mining's index is still stable for the third session running. Top 10 index is up 1.87%. If we just zoom in on the top 10 stocks today, Econet was the only outlier there, coming off 0.87% for it to settle 105.04 cents. While cassava has added about 0.24%, we are expecting the results sometime a little bit later into this year, maybe around June thereabout. InScore has added about 4.68% to settle 163.44 cents. Now, Padenga and Old Mutual are inclusive of Delta. Delta has actually just come back into the green on a year-to-date basis today, coming up 1.25%. After adding 2.97%. Now, this is one counter that was in the red for a couple of weeks prior to today. It has added that much for it to come back into the green, to join the team of Old Mutual and Padenga there, coming out, which are ahead on a year-to-date basis by 30.53 and 24.95%. In that respective order. Now, Old Mutual has been on a consistent rise there, much to do with its dual listing, with it being also listed on the Johannesburg Stock Exchange, which is its primary listing. While Padenga has had a very resilient lifespan on the stock exchange since its inception on the stock exchange. It has somewhat added about 81% year on year to its value, which is way above inflation levels. So it has been a very good counter to really invest in. Recently in their financials, they did mention that they did have a decrease in some of their volumes, but then still they did manage to record an increase in revenue. They also did mention that they are looking to venture into new businesses. On an aside discussion with the CE, he did mention that the business is not yet privy to the public, but then it will be a local based business. I'm sure it should be another export oriented business. This has been pretty much the bane of their performance on the top 10 index, even on the stock exchange as a whole. Now, for our 5-day trends, we are up 5.87% for the all share index, while the miners index is still down 0.17% on a high base effect, while the industrials and top 10 index are up 5.94% and 6.56% in that respective order, with still much show of how the top 10 index has been the driver of the stock market. On to our rises and fallers, we had 26 counters that did trade on the stock market today. 13 were winners, while 3 were losers. While Willdale was the worst performing counter of the day, to settle at 2.14 cents after letting go about 3.17%. Okay, on the other end of the yardstick, did add 12.95% for it to settle at 26 cents. FBC, a banking counter there, did add about 8.57% for it to settle at 38 cents. Banks have had a good run in terms of an increase in their interest incomes, in their interest funded incomes there. A lot of lending has been happening of late. Lending had been a little bit put on hold because of how the market was a much riskier place for them to put their funds in. So then most of the banks did flee to treasury bills, but since there has been a lack of funding within the private sector, that trend is now beginning to pick up again. CBZ, another banking counter, adding 5%. Moving on to our interbank rate market, the Old Mutual implied rate is up 5.17. $1 US as to 5.17 RTGS, while the parallel market did inch up as well to 4.8 per US dollar, and then the interbank has continued on its weakening trend. Some counters on the stock exchange did complain today, notably BAT did mention that they do require about $5 million US per year on average, but then they have been having a huge problem as to securing funds from the interbank market. So I would suggest that the lack of volumes and the confidence within that market has pretty much caused for almost a 35% decline in value from its day of inception.
But of note is the fact that we continue to see these complaints across the board. Almost every analyst briefing that we've been to for the reporting season, it's actually been there's been that sentiment that there's actually a shortage of foreign currency, and you know, if you come back to the trend, you notice that there continues to be that parallel
and it's very worrying since the RBZ and its officials have mentioned that nostril balances have been increasing, yet we do still see this decline it is very worrying for me to see such kind of a trend. It would only lead so many questions to be asked and answered. Those questions I can't give you right now. I would want to really do a very, very deep dive into some of the issues. Although some rumors are to do with companies trading between themselves, but then these are just rumors. We wouldn't really know.
Unconfirmed reports.
Yes.
Well, thank you, Ernest, for the insights. Thank you, viewers, for staying with us. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website, www.equityaccess.net. From the Equity Access team and I, Danki and Asante Sana.